When inflation's this high, that the market has to continue to reprice the expectations of when and if the Federal Reserve is going to actually cut interest rates. And the market now is much more symmetric in thinking not only, yes, it's like 50% chance that they're going to cut interest rates, but there's actually a growing chance that's being priced into markets that the Fed's next move may actually be an interest rate increase, right, a hike at some point. I personally think that that's a relatively low probability still, probably lower than what the market's pricing, but on hold is, I think, a growing default scenario for the next 9 to 12 months for the Fed because inflation's just too high. It's way above their comfort level.
So, Ira, I guess one of the questions is here, did the Fed and Jay Powell back in December, when they kind of had that Fed pivot, started talking a little bit more dovish, in hindsight, was that a mistake?
Well, it was a mistake because their forecasts were wrong, right? Like at the end of the day, the Fed makes forecasts just like everyone makes forecasts, and their forecast for how quickly inflation was going to slow down was incorrect. And we were incorrect too, and we were among the more hawkish or less dovish, probably strategists on the street. The issue that's come up is that when you looked at the survey data, a lot of the survey data back in December and even in January and February, it was pointing toward a slowdown in the economy. So a lot of the traditional indicators for economic activity, like ISM new orders, like some of the consumer confidence surveys, they were all pointing to a potential slowdown. And even though those have rebounded just a little bit, the hard data, so things like retail sales, personal consumption, spending, the jobs data obviously is probably among the most important and visible of these numbers. Those have all been reasonably robust. So there's this disconnect between what people are saying and what people are doing. And I think that that's really been a challenge for forecasters who rely on these surveys for forward-looking indicators, and they just haven't been realized. So, so they made a bad forecast, so therefore they made a bad pivot, and now they have to kind of take some of that back, and that's exactly what you've heard out of a lot of the Fed speakers the last couple of weeks. They're in the quiet period now, so you're not going to hear anything from Fed speakers until next Wednesday. But when you go back and you listen to what Jay Powell said and a lot of the other speakers, they're going to probably continue to say, like, look, unless inflation goes down more significantly and substantially, we're going to keep interest rates on hold. And I think that that's probably what Jay Powell will say next week.
So it sounds like you think then, Ira, that this, print that we got today, the robust inflation prints that we've gotten to start this year, who knows what we'll see tomorrow, doesn't seem to really change the narrative a whole lot, that the economy is still proving to run really strong. Doesn't seem like interest rates are really denting that a whole lot. And that's still the narrative that they're going to go with? Or do you think that anything has changed here?
Yeah, I don't think very much has changed. Interest rate sensitive sectors have certainly been affected by interest rate hikes. But what's happened over the last 15, 20 years is that we've shifted away, firstly, from interest rate sensitive growth to non-interest rate sensitive growth. So things like the services sector, when you dig into the details of today's GDP report, you see that on a seasonally adjusted annualized basis, the services sector saw a 4% growth, whereas the durable goods sector saw a negative 1% growth, right? And durable goods were things like autos, right? So auto sales have slowed down substantially. Part of that's on price. Certainly prices have gone up, but that's also credit availability, right? Large purchases like automobiles and houses, you tend to be purchased on credit of some form or another, and so those are very sensitive to these higher interest rates. Whereas the service sector just isn't. Services aren't services spending have more to do with wages, how much disposable cash you have, as opposed to you're not going to probably go out and go to the movies and then finance that over 10 years, right? That's just not something you're going to do. You're going to spend, but if you have if you get a pay raise, you might go to an extra movie every month, and that's basically what you're seeing in the data. And if those trends continue, then you can wind up having an okay economy, and the Federal Reserve might not have to move interest rates very much at all.